Structural inducement. By now, I believe you already understand what inducement means. As a matter of fact, if you watch any lesson or smart money concepts, different tutors talk about inducement, and liquidity and inducement is a concept that is very common. Today, I just want to talk about inducement briefly. It's going to be a quick lesson where I'm going to briefly touch on inducement and how you can take advantage of inducement to stop losing a lot of money in the financial markets. Inducement areas are traps in the markets. As a matter of fact, an inducement trap is a trading strategy used by market makers. They induce traders to entering positions that are likely going to result in losses, thereby benefiting from it. So how do they benefit from it? When these inducement areas are being created in the markets, a lot of traders are being lured into the wrong side of the market, thereby making them take losses in the financial market. So I'm going to briefly break down inducements in simple terms with this sketch we have on our screen. Before the end of the lesson, you're going to understand how to avoid inducement areas. You're going to understand how to take advantage of inducement because you can actually make money by trading after price must have swept inducement area. So this is basically what I'm going to cover in today's lesson. So for this is a bullish example. And for this bullish example, we all understand what price is doing right here. Firstly, we have the break of this particular high, a valid break of structure. So when we have the break of the high, we have price printing the low right here, and we believe that this is a very good zone. Any trader that is looking at this particular point of interest already understand that this is a good demand zone that is likely going to hold price. Why? Price also sweeps liquidity. So liquidity sweep is actually very necessary in our trading strategy. Price takes liquidity underneath the low, react to the upside, break structure, a valid zone. And believe me, there has to be an imbalance. Imbalance being inefficiency between buyers and sellers. So over here, we had some retracement. I hope you can clearly see that. After price prints this high, price pulls back, prints the low, and we have the reaction to the upside, which equally breaks structure. And believe me, at this particular point, we are likely going to see another zone right here. It's possible that price is going to leave another zone after it must have left an imbalance right here, and probably going to leave another demand zone right here. So this particular point, we have 2 points of interest, but believe me, one of these zones is the inducement area. Just like I said, the inducement area is actually a trap where the institutions build to lure retail traders into the wrong side of the market, to take positions into the wrong side of the market. Secondly, to take position maybe earlier before the real movement. So this particular area is actually a trap. This is a smart money trap, and this is an internal structure inducement area. So at this particular point, this is an inducement area. We have some reasons why this is an inducement area. So firstly, this particular area is likely going to be at premium area of the Fibonacci level, because if you know about the Fibonacci tool, you're going to agree with me, we usually buy from the discount level. And if you're looking to buy at this particular area, I don't think this level is at the discount price, measuring from the low of the range to the high of the range. What are you going to notice? This level is above the equilibrium level. So this pricing is at a premium level. So what you should be doing is actually looking to sell from this particular area and not to buy. So any trader that is looking to buy from this particular point, believe me, price is actually going to sweep this zone. This zone is not going to hold price. Why? Is an inducement area. The least price can do for you is simply sweeping the liquidity underneath the low, dropping into the discount level, because from the discount level, this is when we could decide to buy. And the second thing price could do is possibly rebalancing some of the inefficiencies we have at this particular area, thereby making this an inducement area. So how can we identify inducement area? Firstly, inducement areas are usually located at the premium side when price is bullish. Okay, when price is bullish, you're likely going to identify it at the premium area or the premium level of the Fibonacci 2. Secondly, there are usually imbalances resting underneath the inducement area. Okay, price is likely going to leave some inefficiencies underneath your inducement area. And lastly, we're usually going to have a high probability trading zone underneath your inducement area. And what price could possibly do is simply dropping deeper into the extreme level, which is the high probability zone, and price is actually going to mitigate the extreme level, then reacts, right? This is how it usually happens. And the second way you can actually take advantage or take a trade after price sweeps an inducement area is sometimes when price comes to an inducement area, you might likely see price sweeps the liquidity underneath the inducement area. So what you basically going to do as a smart trader, you trade with smart money concept. So any trader that trades with smart money concepts, I call them smart traders. So at this particular point, price is actually going to sweep that liquidity. So all you have to do is to get your entry pattern right here, where you decide to maybe drop to the lower time frame to get lower time frame confirmations, or you approach the market with the change in state of delivery. Okay, so you can approach the market with change in state of delivery and trade to the upside, provided price taps into the discount level. So this is pretty much the same for the bearish example. At this particular point, believe me, we have a point of interest right here. We have a demand zone, and when the demand zone was formed, what are we seeing here? Price actually broke structure, which makes it a valid demand zone, and there are some inefficiencies right here. Price will always leave some inefficiencies for this to be a high probability trading opportunity. Now over here, you equally have another point of interest. The one we have over here, this is an inducement area. So the last structure before your point of interest most times serves as your inducement area. And if you decide to make use of your Fibonacci tool right now, you're going to see that this zone is at the discount price of this Fibonacci level, right? This one is at a discount price. So the only area which you'll be looking to sell from has to be the premium level, because in this case is a bearish example. So here is going to serve as an inducement, and you're going to agree with me that now price is returning its blast through this inducement area. It wasn't able to hold price, and finally price comes back to mitigate the extreme level, right? Before we have the reaction to the downside. Now, there are some other ways price reacts to inducement areas. Let's go back to this particular example, the first one we have right here. So sometimes this is how price reacts to inducement areas. Price might actually come, offer some reaction. There is possibility that price is going to build some liquidity above there, right? Price might build more liquidity this way, right, before it drops to a point of interest. So when you see something like this, know that this has now moved from just an inducement area to a liquidity pool. Okay, it have moved from inducement area to a liquidity pool, making it a high probability setup. The zone right here has more probability because price has now built some liquidity above this high. So when you approach this kind of setup, approach with confidence, because price is certainly going to give you good results. I don't want this lesson to take a lot of time. Let's look at some price action example, and I believe it's going to help us understand these concepts better. So looking at the price chart right now, this is on GBP/USD 1 hour time frame. So analysis, we're going to start on the 13th of November 2024. And from what you can see, from tomorrow is going to be the first day of December. So we're coming to the end of this year, and it was actually a great year for us traders. So looking at the price action right here, you can clearly see that we have good price action before price reacted to the upside. So let's try to know our price range. This is the range right here. This low right here to this particular high is your price range. Okay, that's your range. And if you agree with me, we have some points of interest, right? This is a good point of interest right here. This is a demand zone. And from what you can see, price actually came back from mitigation. So a very good demand zone right here is actually a large zone when it comes to zone selection. Okay, it's a large zone, but this is a very good demand zone at that. So we actually have price pulling back right here and continue to the upside. And this is where some traders makes a little mistake. So this particular area, some people actually mark here to trade from this particular point of interest, but marking here is not actually the best thing to do, because that's your inducement area. This is where your Fibonacci tool can help you out. It doesn't mean that Fibonacci tool is always the major tool to try identify your inducement area. No, from your naked eye, you should know that this is an inducement area, because for this setup to be valid, there needs to be an available liquidity. So this is the liquidity in front of this point of interest. So that simply makes it your inducement area. But making use of our Fibonacci tool from the low of the range to the highest point of the range, what can you see? Can agree with me that this particular zone right here is actually at the premium level. So please, being at the premium level simply means that is an inducement area, and buying from there is not the best thing to do. The best thing to do is to wait for the extreme level. Not just that, another thing you're going to identify is that at this particular point of interest, we have some price imbalance. I hope you can see that this is an imbalance at this particular area. I hope you can see Price left some inefficiencies there. So what price basically did is that this particular area, which is your inducement area, price came back to that particular point of interest, sweeps the inducement we have right there, and rebalances some inefficiencies. Okay, rebalances some inefficiencies, and we have that reaction to the upside. So if you drop to the lower time frame, if you want to trade the turtle soup pattern, can agree with me that you're going to get good entry pattern right here, which is going to help you get some trades to the upside. Now, continuing analysis, all we can clearly see is that this reaction right here was able to break structure to the upside, and after it broke structure to the upside, we have the reversal to the downside where price was able to shift in structure. I hope you can see that. At this particular point, we have a market structure shift, which means that we actually going to have some shift in the trend of the market. Don't forget, we still have this demand zone underneath this particular low. Now, what are you going to notice? You can notice that we have some institutional candles that was able to leave some inefficiencies right here. I hope you can see that inefficiency. Price left an inducement area once more. I hope you can see that. You see, this is an inducement area. This is the main inducement candle. That is the structural inducement candle. And if you see, if I try to extend, we have two touches at this particular area. So that's another inducement area. And just like I explained, we're actually going to expect that price is going to come back to sweep this inducement area. A lot of people might actually be paying attention to trade from here. This is a trap. And if you see this kind of trap in the market, do well to disregard that. Don't look to trade from that particular trap. Another thing you're going to notice if you try to use your fib tool, maybe using your fib tool at this particular point, measuring from the high of the range to I think the low of the range, what are you going to notice? You're going to notice that this particular point of interest, this particular inducement area, is just slightly inside the equilibrium level. So this is a valid inducement for me. Okay, it's a valid inducement area for me. So anyone that is trying to trade from there is trading from a trap. Now, marking your real point of interest, this is the main zone you're going to trade from, your main supply level right there. I hope you can see that. Now, what you can clearly see is we have a good point of interest. At this particular point, we bought to sell, right? So price reacted from the demand level, giving us good price action. After that, price sweeps the inducement you have right here, mitigates our point of interest, and from there, we have good reaction to the downside. Now, let's pay attention to the reaction to the downside. So from here, price drops with an institutional candle, which left inefficiencies. I hope you can see the inefficiencies. And from there, it was able to break underneath this low, which confirms that we are shifting in structure. Do you believe we equally have another inducement? This is the next inducement area. We have inefficiencies right here. And if you try to use your Fibonacci tool from this particular high to where we had this first pullback before the continuation, you can see that. So making use of the Fib tool from this high to where we had the first pullback. So this is an inducement area because price is currently at the discount level. But if you try to measure maybe to the current low, you see it entered the equilibrium level. But anyways, with your clear eye, you can clearly see that we have some inefficiencies at these particular areas. And if you're trying to trade from this particular area, just have it in mind that is a trap. Why is this a trap? We have these inefficiencies. And from what you can see, we have the extreme level, which is going to serve as our main demand zone. So this is the correct point of interest. So this is the real POI. So this is the real POI. This is the main point of interest. And this particular one right here is actually the trap. And if you see, since we have this inefficiency, what do we see? When price was actually coming back, firstly, it sweeps the liquidity. You can see that when price came back, firstly sweeps the liquidity, drops, comes again, sweeps the inducement area, and goes ahead to rebalance some inefficiencies we have right here. And after that, we have some pullbacks. Now, price came back once again. You see, this is the second time price came back. What is it coming back to do? It came back to rebalance some inefficiencies as well. I hope you can see that. We probably have some inefficiencies which price came back the second time to rebalance. So, one thing I want you to take away from this particular lesson is that to identify a valid inducement, there has to be inefficiencies before that inducement. I hope you can see just over here. Let me try to delete this and explain it so you understand it well. So over here, what can you clearly see? This is your inducement area. What makes it valid? We have inefficiencies. The next one, this is your inducement area. What makes it valid? We have an inefficiency. I hope you can see that. The next one, this is an inducement area. What makes it valid? We have an inefficiency. I hope this makes sense to you now. This is a top secret I'm reviewing to you now if you're struggling to identify your inducement area. So price came back, and at this particular point, price starts to build a pool of liquidity. I hope you see this is now a very large liquidity void which needs to be filled. Price builds a lot of liquidity at this particular point, and finally price returned to the real point of interest, right? This particular setup, I saw it last week. So I was actually having interest, and I said, okay, by this week, I'm going to get involved on this particular trade opportunity. So during the Monday's open, I totally forgot about these points of interest. Totally forgot that. So I couldn't trade from there. When I had meeting with my VIP students yesterday, I was actually talking about it. I was telling them that I actually had these points of interest, but I forgot to trade from there, and it was painful. Do you know why it was painful? I didn't win any trade this week. So if I actually remember this one, I would have won this particular setup. But it's all good. We still get to see new opportunities. So price drops from there, and it was able to sweep the external range liquidity. So this is actually the last example, and this particular point of interest, I also looked at it, but I didn't trade this particular one. I had it after I missed the first one, so I had the second one, and I couldn't trade from there. So where is our inducement area right here? If I try to zoom in, you're actually going to see this particular spike. This particular spike is our inducement in this particular example, because you see immediately after the spike, we have some inefficiencies, and this is where we have a point of interest. This is supply level right here. You can see that is a supply level, and this is the real supply. Now price went ahead to build some fresh inducements. So from this particular area, immediately price formed this particular high, the retracement. Some traders are actually going to jump into an early sell. They think, oh, price is leaving us, it's not getting to this point of interest. They're going to jump into selling back to mitigate the real point of interest, and after that we have that reversal from there. Good example and good point of interest right here. So a lot of people is actually going to ask, is this a valid point of interest? This is just a week. Yeah, it's a week from what you've seen, but dropping to the lower time frame, you're going to see the real point of interest. So this is the 30-minute time frame, and on the 30-minute time frame, what can you clearly see? See, this is a range right here. It's low price action. After that, price sweeps liquidity, drops with massive candle. So it's a valid one because we actually have some liquidity sweep right here. It's a valid point of interest. So this is it right here about structural inducement, understanding the inducement inside the internal structure. I believe we have another one right here because we have a good price action where price moved with good candle. In my book, this is not valid. It's not a valid point of interest. And we see we have some inefficiencies. How do we identify our inducements? We do have what? Inefficiency just very close to this inducement, and this is the real point of interest down here. Now price builds more liquidity to make it valid. This is a trend line liquidity right here, a very large liquidity pool that needs to be rebalanced. Finally, price got to the main point of interest right here. You have the mitigation. That's why we're getting the reaction to the upside. But based on my analysis, I'm still expecting that this zone is going to hold price because this is a higher time frame point of interest. And if you try to zoom out, the main structure and the main order flow currently is bearish. Order flow is bearish. So our expectation is that price is going to take to external sell side liquidity. I hope this concept makes sense to you, and I believe you got value from this particular lesson. So if you got value, you can consider subscribing to the channel, and the link to our free Telegram community is in the description. I'm Solomon Wisdom, and here is Born to Trade. If you have interest in enrolling for our mentorship, this is actually the best time to enroll for our mentorship. So by next year, you push the market harder with the knowledge you're going to get from our mentorship. So thanks very much for watching this particular lesson. See you in the next lesson.